Hi everyone, in the previous video we started analyzing bonds and bond amortization, and we looked at the very first year. We are going to continue looking at the same exercise, and we are going to finish our bond amortization table. So the beginning book value of a bond of a given year is the ending book value of the previous year. Please note that the cash outflows, the interest payments, are also known as coupon payments, will stay the same across all years. It's going to be $60. That's what the company is going to pay, except the last year they are not only going to pay the $60, but they are going to pay the face value as well. And we calculate the interest expense by taking the beginning book value and then multiplying by the yield to maturity of the bond, which is what the market demands for a particular bond. And the ending book value is going to be beginning book value minus any payments for this bond, which is the cash outflow, plus the interest expense. So interest adds on top of the book value, and any cash you pay for the bond decreases that amount. And we are going to pretty much do the same across all years, and we are going to calculate the ending book value. As you see, at the end of the year 10, this was a 10-year bond. At the end of year 10, the book value was $10,000, and then there's not going to be an interest expense, and at the end, when we pay the face value, you are going to end up with zero. That's kind of the goal here. So what you are seeing here is practically the interest expense is probably the most important one, where you take the beginning book value of a bond and multiply it by yield to maturity. Now let's take a look at the different questions that we have. It says it's now December 31st, 2022. The prevailing interest rates are 3%. From an accounting perspective, it doesn't matter whether they are 3% or 4% or 5%. It will change the market value of the bond, but the accounting treatment is not going to change. That said, the interest expense for 2022 is going to be $46.49 for this bond. This is what we calculated here. The interest expense is going to be recorded here. As a result, the cash outflow, the interest payment, is $60 in 2022, and not only in 2022, for the rest of the years, except last year where you are going to pay the face value. It's going to be the same. And the book value at the end of the year is what we calculated here. At the end of 2022, the book value decreases to $1,148.71. Eventually, since coupon rate 6% is higher than what the market demands, this bond is selling at premium. It's about $1,000, and it's going to converge eventually to 1,000 to face value, and at the end you are going to pay the face value and take the bond off of your books. Let's continue recording the transactions in year 2022. So what we are doing is we are paying cash in the amount of $60. So that's going to be a debit. We are going to have retained earnings. Retained earnings is going to decrease with the interest expense, and we calculated that for $46.49, which was the beginning book value of the bond multiplied by the yield to maturity. And there is an imbalance between a credit entry and the debit entry. There needs to be an additional debit entry, which is going to decrease bonds payable. And at the end of 2022, what we are going to have, the book value is going to be the difference between the two. And as you are going to see, let's make this a bit bigger, $1,148.71 is what we calculated here. So you are paying $60 cash. Your interest expense is calculated by the book value multiplied by yield to maturity is less than what you are paying. As a result, the book value of your bond is going to decrease. In 2022, it's decreasing to $1,148.71, and eventually it's going to converge to $1,000 face value, which you will pay at the end of the term. This is pretty much what I want to cover for this type of bond. In the next video, we are going to cover American bonds, which pay coupons on a semi-annual basis.